afternoon. We are really excited to have you all here. We basically want to answer two major questions today in this webinar. One is, can you really forecast returns with reasonable certainty? And to add to it, can we do it intuitively using nothing more than rolling returns and basic stats? So we'll try to keep this webinar engaging as far as possible. We'll have multiple polls where we would like to keep having your feedbacks, and you can actually post your questions whenever you like throughout the webinar, and we'll be taking it together towards the end of it. So with this, I will hand it over to Kisle to take us forward through those questions. Over to you. I think you're on mute, Kisle.
Yeah. I hope I'm audible and visible.
It's loud and clear.
Okay. Thank you. Okay. Before I share my screen, again, thank you everyone for joining, and thank you, Apur, for letting us know the exciting part, which is we might be able to understand if there is a way to predict future. Right. So, okay. Let me know if when the screen is visible.
Yes, I can see your screen.
Okay. The slide is all you can see, right?
No, the entire screen.
Yes. Okay. Okay. Yes. So that's the interesting question. How can somebody predict returns? And when we think about it, it is not just about predicting returns. It's about predicting future in every aspect of life. And do we do it most of the times? Probably we do, right? How often have we predicted the future? We have predicted the weather. How often have we predicted the elections? How often we have predicted the result outcome of a cricket match, a football match, and whatnot. We keep doing it, right? And obviously, but there was a movie wherein Oracle, a movie called Matrix, wherein Oracle was a personality who could see future very well. What it meant was she could predict future with reasonable certainty, and repeatedly it came out to be true. That is how you know that a person is able to predict future very well, right? So I want to start with a poll. How do you know if a prediction has actually worked? You should see this poll on your screen shortly. Now the question actually, I know it's a very simple question. What I want to understand is, what is the principle to assess whether somebody is good at predicting future? That somebody can be a person, it could be Oracle in Matrix, or it could be any simple framework or a method. How do we know if it has, if the prediction has actually worked?
The poll should be available to you guys. I think you can go ahead and select your choices.
And yes, we are responsible. Okay, now that you have answered, so I know now there is no one right answer to it. So this whole, I do not expect a very skewed response distribution across all our audience today. There is no right answer. There is no exact answer. How do we know if the prediction has actually? But there are definitely a few defining principles which will be accepted consistently across most disciplines, I would say, which would say that the prediction has worked accurately. And it's quite obvious by checking how close the actual results were was compared to the predicted results. And it's not just one return, it's not just one outcome, it has to be multiple outcomes, and the accuracy and the reliability has to be repeatable. As in, let's say you are able to predict the outcome of a cricket match very accurately in 9 out of 10 matches that you predict. That is an example of repeatedly and consistently being able to predict outcomes, and then we can say it is a reliable outcome. And when again, I want to point here that it might not mean exact point-to-point prediction. It might mean expected ranges. If there is a predictor who can say that it will rain for sure today, it might rain very heavily or slightly or moderately. That is a range, right? It will rain between moderate to high, very heavy. So that's a range of outcome that can also be predicted. This expected range is a very important concept that we'll be covering next. And now coming back to our example, I know all of you are here to understand how can we predict future returns, not predict weather or cricket, right? So if there is a methodology which is able to predict, let's say, indices, the Nifty indices, different mutual funds, or your own created rule-based strategies, like simple rules. Market indices are also simple rules, like Nifty 50 is simply selecting top 50 companies of the country in terms of free float market cap and some constraints. That's also very simple. Nifty 100, Nifty 500, Nifty small cap, all these indices are simple rules. Similarly, you can have your own rule-based strategies, which you can, which are essentially transparent conditions to identify portfolios, similar to market indices. Now, if a methodology is working consistently across these three categories, we can very well say that the framework is good enough to predict future of returns of fund. And how do we know it has worked? So yes, we have been running this strategy for, we have been running this method pretty much for the past, I think for the past decade. But in the current construct, for the past 4 years, we have been running this system, this prediction system, which uses very basic statistics and the concept of rolling returns. I will come to what rolling returns are, but it's just a method to look at history when we are looking at returns. And using basic statistics, we are able to predict future. And when I say we are able to predict future, we mean a range of outcome of the future returns which are possible. So we have been running it for the past 4 years. We have predicted our strategies and investment rules fairly accurately. We'll just get to the proof shortly. And what we know is the same works for indices and mutual funds also. It's not just our rules that can be predicted using this framework. Index and mutual funds can also be predicted using this framework. So if you want to assess any fund and have realistic expectations as to what to expect in terms of return, what will be your future wealth if you are investing in a particular fund, you can use this framework probably quite reliably. And more importantly, you can choose different funds based on your own risk requirements. You might have a risky fund or higher standard deviation fund when you are saving for a less important goal, let's say a second holiday home, but you might want to have a very low risk portfolio, a low risk fund when you are saving up for something very important, which might be your child's college tuition fees. So that is how you can decide, once you know what to expect in terms of return and risk and predictability of a fund, as in you can align with your different goals, how risky they are. And yes, I know I've taken a lot of time. We'll come to the proof. Yes, how the proof will show you how reliably it works. So for that, I'll just quickly show you a glimpse. We'll get to the detailed proof later, but I just want to show you what we mean by proof. So if you look at this is Nifty 50. We were predicting the returns sitting in January 2022. Actually, coincidentally, that's the time when we launched one of our flagship strategies also. That's when we were predicting futures. So if we are sitting in January 2022, exactly 25th January 2022, that's a special date in itself, a separate story. But this is when we were predicting, and just look at what was predicted. Is there an exact point prediction that you can see? Probably not. You can see one base case, which is this line, which is the most likely or the most expected path. This darker shade region is what is the more likely part, and this lighter shade boundary is 95, slightly less likely. And beyond this shaded region, it is almost very, very unlikely. Our model says that it will never happen, that beyond this second line, this outer shaded region, the returns will fall. And what did we see actually happen? So I'll just recap. The most expected line is the baseline, this dotted blue line. Highly likely case is one standard deviation. And this outer outer shaded region is something beyond which returns will very rarely go, if this prediction model works. And let's see if it works. So if we look at Nifty 50 and we see that since January 2022 till today, over 3.5 years later, we see that the predicted green line, blue is the historical return, green is the predicted line, actual live return, sorry, not the predicted. The actual live returns of the index Nifty 50 has been very close to the expected or the predicted line. And the same is what we can observe at Nifty 50 also. Again, the green line, which is the live return, the live index, has been around the base case and definitely between the first standard deviation or the darker shade, and double definitely within the outer shaded region, beyond which it will probably never go if our prediction works well. And we can see that it didn't even go beyond first darker shade also. And if you look at other also, Nifty 200, again, it has performed around their baseline only, and definitely between the darker shade. Again, I'll just use one technical term. The darker shade is known as one standard deviation or a 65% confidence interval. The lighter shade is known as two standard deviations or 95% confidence interval. Very roughly, you can assume that we can say that 95% of the outcomes will lie within this outer range, 65% will lie within this inner range. So again, we can see for Nifty 200 also this prediction has worked, and so it has worked for Nifty 500 also, right? So, and for many other indices, we'll get into it in more detail. It has worked, and so it has worked for several mutual funds. We looked at a few mutual funds also, something like Axis Blue Chip. It has also, since January 2022, we took the cutoff date as January 2022 for everything. And here we can see again, Axis Blue Chip Fund, which is a large cap fund, when predicted in January 2022, it has stayed slightly below its long-term predicted range, but it is still within the darker shade. I think currently it's around, in the last 3.5 years, it has generated maybe 10-11% returns only. And that's slightly below the long-term expectation. And we can see for Bandhan large cap, for example, it has stayed on its predicted path only. And this one is a newer fund, so maybe we can skip that. And this one is Canara Robeco Blue Chip Fund, again, which has exactly stayed on its expected path. And again, I want to show you one more category of proof, which is our own rules. So we created certain rules, basic, simple, fundamental rules. As I'll repeat, just like indices are also a set of rules. For example, Nifty 50 is top 50 companies. We have our own set of rules, which probably, let's say, selects companies which have very good return on capital, selects companies which have low leverage, selects companies which have high profitability and high consistent growth. Let's say these are certain rules that are used to select the companies, and their backtested, their live return performance has been also around the same region. So this is the baseline, the predicted, the first standard deviation and two standard deviation, and it has stayed within the expected range. You can see it for most of the strategies. Most of the rules, it has stayed in that range. So yeah, this was the proof part. Now I'm going to go back. So that's the proof that our prediction system has worked. I'll just ask a question. Do you think it is proof enough, reliable enough so far that there is a framework which can reasonably, realistically predict at least a range of outcomes? Please, if you have an answer, please answer it in the chat. If you're still not convinced, which is totally okay, hopefully you will towards the end. But now I want to ask you one very fundamental question. As I said, all of us often predict future. We predict weather, we predict cricket, we predict every small thing. Every decision we make is by predicting the outcome of that decision, right? We take a decision if we are able to predict that this decision is better for me compared to decision choice 2. So we keep predicting future all the time. Have we ever thought, how do we predict? What is the principle we used? And often people are confused that looking at history is not the right way to predict future. But then what is? There is nothing. We don't have anything other than history. When you say that it is going to rain today, it's because you have observed in the past historical observations that whenever it's cloudy, it's windy, and there are certain climatic conditions, it usually rains. That is why you said it will probably rain today. But it is based on your historical observation only, right? And closer the observation, more number of variables you can assess accurately, better the prediction would be. That is why a weather forecast will be lot more, professional weather forecast will be lot more accurate than a person just predicting using hunches. So the principle behind prediction is observing history very granularly, very closely and deeply. Yes, history doesn't rhyme. It doesn't mean that it has happened in the past, it will happen in the future. But when we study those historical patterns very closely, we find there are repeatable patterns, and we find how repeatable or non-repeatable it is. So, and the goal is not to predict exact numbers, but the probable outcomes. This is a very, very important, hope my cursor is visible, Apurv, is it?
Yes, it is.
Okay. So that the most probable outcomes, the range of outcomes is what we are talking about. If you remember that the chart that we saw below before, they had a certain range. One line was the base case, then there was one very likely case, and then there was one another less likely case, but beyond which it will never go. So that is the range of outcomes it has predicted. So that is the range we are working on, right? Now I want to come to real story, the real meat of this webinar. And before we get into that, let me ask this question. This is a poll you would see in front of you. How do you currently assess return expectations? And what I'm exactly asking is, how do you currently select mutual funds? Because it's the same question, right? You select those funds where you expect the returns to be best, the risk to be least, the return to be highest. Best outcome predicted as per you is what you select, right? How do you select it? Take a pause and let you answer. Do we have the poll floated upward?
Yes. So
Okay.
till now, around 50% of people say it's historical averages, and another 50 say it's model-based forecast.
Wow. Okay. So our audience mix is something very interesting. So that's very, very good to hear that our 50% of audience thinks it's model-based forecast. That's a very good advanced system. And historical averages is again, there is a way to look at historical averages, and if looked at historical averages in a right manner with the right lens and in a right granular manner, it can predict future. I'm very surprised and pleasantly surprised that we didn't get much response around past CAGR. because this, in my opinion, my friends, your friends probably, who are not very well versed with or who are not into model based forecast and looking at historical averages in a very minute way, very simply use past CAGR. 1 year, 3 year, 5 year CAGR से sort किया, and once these sorted number, we sort these mutual funds based on 3-year CAGR and choose the top 5 funds, and we are very happy about it. Yes, that is not a very accurate way to do it. So thank you for answering. And now there is one more poll. Now that 50% of our audience has answered that they have used model-based forecast, I will be very interested to get the answer of this poll. Have you used rolling returns before? Though people who have answered historical averages, those who have answered model forecasts, both of them might already understand what rolling returns are.
True. And I think this session will be more helpful to those.
You have the responses?
We've just made it live. So yeah.
Okay. Okay.
Yes, we are getting the responses. Many are saying heard of it but never used. Few are saying occasionally but for validation. Okay, occasionally and for validation.
This means that we have quite advanced our audience is constituted by people who are already using return matrix better than differently, maybe in more data-backed manner rather than based on intuition. Very encouraging to hear that. Thank you for answering, guys. Great. If you are already aware of rolling returns, this will be even more fun. Yes, as I said, some of you answered historical averages, few of you answered model-based forecasts. The basic principle being looking at history. Even models are based on studying history and finding patterns in a very finding patterns which are repeatable, consistent, and reliable. These patterns are what are identified by even the most complex models out there in the world. If you talk about the random forest and neural networks and deep learning models to very simple rule-based systems also, they are essentially trying to identify patterns in history, and such patterns which are repeatable and also have a fundamental backing, which means there is a fundamental reason for the patterns to exist, and it will keep happening in future. I can give a very interesting example of a very simple pattern. One very simple pattern is, which happens very often, very consistently, maybe not 100% of the time, but very often, very consistently, is students who have been very consistent, very hardworking, who have been able to have control over instant gratification need, who have been able to control their emotions and been able to drive discipline in their life throughout their life, usually or most likely go on to become great employees and great managers and great CEOs in future. Is that a pattern you would agree with? There is a there is a saying in Hindi, "Honhar birwan ke ho chikne paat," which means that there are signs that to tell who is going to be a, let's say, a leader in his field, who is going to be a very effective at his work. There are signs of telling that. Is that a pattern that is repeatable? Yes. Is that a pattern that has a fundamental backing? Yes. It's obvious somebody who is disciplined and hardworking will probably do well if he continues to be disciplined and hardworking. So this is what I mean by studying history to find patterns which repeat. These patterns can be very simple filter patterns like we just spoke about, which are very obvious, very intuitive. Somewhat of you would even laugh it off saying that itne simple pattern ki baat kar rahe hain. And then there can be an extreme, different extreme, which are very complex patterns, which are trying to capture more nuanced and intricate behavior out there in the capital markets. And everything in between is what is captured using historical analysis using rolling returns. So what are rolling returns? If there is a quick definition of rolling returns, anyone of you want to take a shot at, please put it in the chat or Q&A. We'll be happy to hear. Rolling windows are actually looking at returns of any fund across multiple windows. So and why do we need to look at multiple windows? Let's say if you had started investing at the peak of 2008, how would your return would have been in the next 3 years or next 1 year, and versus when you entered into investment in 2015 or 2018 or 2012 or 2004, right? What it means that the window, what window you choose will decide what sort of returns your history has shown. For 2008, it could be minus 56% for the index. And for 2000, very next year, it could be almost 80-90%, right? 2009, say. So if you have to study history properly, then we have to look at multiple windows and multiple investment horizons also. This is what is rolling return. Rolling windows or rolling return. I just wanted to show a quick video if you are interested. I'll just maybe share it very quickly. Give me a second. It is not.
Yes.
Is it?
Yes, it is.
Okay. So let's go through this clip. You'll just visually tell us what rolling returns are and what it means to have such granular understanding of returns from different starting points, different macroeconomic conditions. One could be recession. During recession, one could be a very significant boom of policy-led reforms, or one could be a dot-com boom. It could be many different windows, many different conditions and scenarios, what it means to study returns across all those conditions and scenarios.
Rolling returns is an effective way to study a strategy's track record. And extensive the study, deeper the insight. So, we should look at multiple, or better, all rolling returns, and study multiple investment horizons also. What if I invested for 2 years, 3 years? In fact, let's study all rolling returns of multiple investment horizons. These rolling returns are very rich source of information. They have insights on business, investing, and human psychology.
I like the animation of this quite a lot. It was quite fun to make it also. But hope it was able to drive the point. So the reason we look at rolling returns is to understand the entire scenario, all outcomes. So we know the history, so we know the expectations, not just in a very naive small window, but by looking at a very vast range of data sets. It tells us how a strategy will perform in different conditions, in bull market and in bear market, in recession and in boom, and everything in between. That is what rolling returns are. And now hope rolling returns are clear. I know rolling returns can be a separate 2-hour session in itself. We'll not get into this right now, maybe next time. But here is a poll. You can see the poll on my screen. I'll just explain it.
Yeah, we are getting responses. Many people are saying definitely yes.
I think this webinar is, the audience here already knows most of the things. So I'm glad it's interactive. I hope it was even more, we could sit and discuss.
Yeah.
Brilliant. So this is how important, how effective rolling returns can be in predicting future 1, 3, 5 year snapshots. Okay, but what do we do with these rolling returns? You remember that video clip that we just saw, right? There were multiple numbers, so many numbers. What do we do with those numbers? I'll tell you. Don't worry. Again, the audience is equipped enough, but still I'll mention very basic statistics is all we need to at least come up with certain ranges. Of course, there are advanced statistics that we used at our fund level, but a good majority, a good chunk of the information is captured using very simple, effective statistical measures, and we all know it since we have studied it in our school also. One is the mean, the average of all the rolling returns. Let's say for 1 year, there is a particular 1 year investment horizon. There is one mean. For 5 year investment horizon, there is a separate mean. So these means, averages are the most expected outcome. Remember that predicted blue line, right? That is the mean line. And then there is standard deviation. Standard deviation is a very interesting concept. It's very interesting to know that risk is captured through dispersion of returns. Most popular metric of risk is not how much money you have lost or how much money you will lose. What is the probability of getting negative returns? These are not the most popular or traditional metric to assess risk. The most traditional and popular metric to assess risk are the volatility of returns. How dispersed the returns have been. Let's say if there are two funds, both of them an average of 15% return, but for one of them, the average is made of 13% and 15%, which comes out to be average of 14%. And the other one is minus 0% and 28%, which again comes out to be average of 14% only. But this has a very wide range. The least could be 0, the maximum could be 28. So this uncertainty, this spread, this volatility is what we define as risk. And as I'm saying, I'm sure my audience, our audience today would already have figured that how standard deviation transpired into those return ranges and confidence intervals that we just saw and will see again. So that is what return and risk. So basically, return and risk are the two most important or maybe that is how we can break assessment of any strategy into very two basic categories: return and risk. Right? So return can be measured using mean return, and the risk or the volatility can be measured using standard deviation. And of course, everybody wants higher return and with low risk, but it never happens, right? There is no free lunch. You can't get higher return with lower risk. You can technically, of course. But yes, usually higher return might be accompanied with higher risk. So we have to look at risk-adjusted return, which is Sortino ratio. Don't want to focus too much on this, which is simply mean return divided by standard deviation, very simply, adjusting for risk-free rate, of course. Which means that numerator is return, which is more the better, and the denominator is risk or the standard deviation, lesser the better. So higher the Sortino ratio, the better. So that is the basic statistics we use to predict returns. So just to a quick recap, rolling returns gives us all the different windows and their corresponding returns. And how we use those returns to predict future is using very basic statistics of risk and return, mean and standard deviation. That is one very basic method we can do. And that is what gives us the base case and the best case or the worst case. So usually the base case is the most likely outcome, which is the return, the mean return. The best case is mean return plus 2 standard deviation. In statistics, is often called as 95% confidence interval plus or minus 2 standard deviation. Okay, by the way, plus minus 3 standard deviation is something very common, which all of us would have heard. Even those who are not familiar with standard deviation so much, remember 6 sigma, right? It's a very popular method to minimize or metric to minimize the defects in a manufacturing company. So if there is 6 sigma is also known as 1 ppm, 1 part per million, which means that 99.9, a very high 99.7% something of the outcomes will lie between in that range. Only very few cases will lie beyond that range. So if companies, especially Japanese companies who follow Kaizen, who follow Kanban, these companies have a very strong Six Sigma implementation, which means that the number of defects their goods can come up with, their goods can have, will be very rare, very low probability. So that is Six Sigma, 3 standard deviation plus and minus. We are talking about 2 standard deviations plus and minus, which means 95% confidence interval, or in other words, 95% of the times your return will fall within that range is what the expectation is. So that is prediction based on basic statistics, which will give us the base case, best case, and the worst case. And now finally we are here. Thank you for being very patient. I know you wanted to look at the predictions and the actual outcomes of the indices and mutual funds and the rules. I gave you a teaser at the start. Let us look at it again. And now it will make much more sense to us. So this is the base case. Darker shade and shade is above that is this is the best case. This is the worst case. And this is another best and worst case based on 1 standard deviation. 1 standard deviation means 65% confidence interval roughly. And this is 95% confidence interval. So if you look at Nifty 50, just imagine what a wonderful rule, what a repeatable pattern this is. This index, which simply selects top 50 companies, and we backtested it not for the last 5 years, last 10 years, for the last almost 3 decades. 3 decades is a pretty long time. And in the last 3 decades, the rule pattern has been quite consistent. Just imagine, we predicted in 2022 based on last 3 decades of data, and the returns came out to be around very close to the baseline. And definitely between the darker shader and double definitely between the lighter shade, right? And so with Nifty 100, which selects top 100 companies of the country. ये भी अपने base case के पास lie किया, and Nifty 200 and Nifty 500 also, which captures top 500 companies of the country. And then even now it's getting interesting now. Even certain factor-based indices like alpha or momentum and so on, all of these are also we are able to closely predict the returns of these indices also using this rolling return and basic statistics ka framework. So if you look at Alpha 50 also, you see pretty much the same thing. Nifty Auto has been an interesting thing. It is still definitely between 1 standard deviation and 100% between 2 standard deviations, but it is above its base case. So in the last 3 years, Nifty Auto, and we know Auto has done well in the past few years. We know the cycles, what had happened in 22 and 23 and then 24. And we see it in front of our eyes also. Okay, Auto has performed well. So you see, it might not be necessary or 100% predictable that it will lie around the baseline only. But you see, most of the cases it is lying around base case. And in certain cases, it is lying around 1 standard deviation, but almost never around 2 standard deviation. Is it exactly what we spoke about when we talked about predicting future returns? Yes, we spoke about 65% confidence interval means 65% of the case times the return will lie here. 95 means 95% of the times, right? So we see that is happening in true examples, live examples also. Nifty banking portfolio. Banking is a very hot favorite of many I know, including mine. I used to be a banking BFSI analyst, and had I known back then that there could be a very interesting way to predict banking returns, it would have been very interesting. And then there is energy sector, again the same thing. And then FMCG, very close. We know what has happened in the last 3 years. And then we have healthcare, pharma, and Nifty IT also has been around the same range. And this is low vol, another factor, volatility factor, which is exactly at its predicted case. And then we have the micro cap. Yes, this is small. We know what has happened with micro cap in 23, around 23, 24, right? And we see here it has generated a lot of return, but it is still within its predicted range. And mind you, the predicted range is changing significantly. Here, the predicted range are 20, 16, 15%. On Nifty 50, you remember we saw it was around 14%. So the predicted range has jumped up, but still the prediction outcome is around that. And when we look at mid cap also, it's the same, and small cap 250 is also showing similar values. And the value factor, the value index, which selects low valued companies, low PE companies, cheaper, quote unquote, cheaper companies, has also done the same. And again, there's another Lowell index, and this is a quality index, which selects companies based on consistency of capital efficiency and growth. Again, this is also falling within its predicted range. And momentum, a hot favorite, which is not a fundamental factor according to me. This is a trading factor, a technical factor. And this is also falling within its range, and all other indices. So it's very, it is very logical that something, a portfolio which is built on rules, will have predictable and repeatable patterns, right? It's obvious that if you have transparent, clear rules to select a portfolio, it will have higher chances of having predictable outcomes. But we are talking about mutual funds. Mutual funds didn't have, in the last 20 years, mutual fund didn't have objective frameworks. We used to work in the traditional manner. We were a set of analysts who would sit and brainstorm on certain ideas and come up with the final decisions to make investment in certain companies. Now, the mutual funds philosophy and methodology change over the years. No single fund manager stays with a fund house for 20, 30 years. And even if he does, their styles might change. And if fund manager changes and maybe KMP, the fund house is not very institutionalized, which was the case in the last 20, 30 years. Mutual funds is a new story in India. So in the last 20 years only it has come up. So it was not a very institutionalized framework-based thing, which could have repeatable philosophies and consistent, stable philosophies across decades. And yet, even mutual funds we are able to predict mutual funds also very accurately using this methodology. So again, we see that most of the mutual funds, be it DSP Top 100, Edelweiss Large Cap, or Grow Large Cap, or HDFC and HSBC and ITI, and every fund house have their large cap and small cap portfolios also. I'm sure we'll come across those also. All of those are lying within their range. And you see, what we observed was more than 70 to 80% of the times it's around the base case only. 10-15% times it is above or below the base case, but within one standard deviation. And only 5% of the times did we observe that it touched the one standard deviation boundary. Never did we observe so far that it has even gone beyond one standard deviation. Almost never. So that's the just imagine how predictable. 70% of the times it's around the baseline. That's magic. That's oracle-like prediction is what I believe. So, and this is true with most large cap across fund houses and everything. And then let's come at, so because some of you might have reservations that mutual funds perform within a range. So if you predict certain return for most of the mutual funds, most of them might fall in the same range. There might be reservations and questions like that. Let me answer that. Again, as I said, rules are more predictable, and our rules we have observed. Look at this. The predicted return here is 27%. It is not 13% or 14% like index. It's almost double that of index. And yet the same framework is maintained. This rule has generated around 25% or so returns in the last 3 years, and it has been around the predicted range only. And so we see for other rules also, it has stayed 27% returns, it has stayed 37% return, 31% return, and still it has stayed in the same zone. It's not that we are predicting 12 to 14% and showing that everything is falling under 12 to 14%. We are predicting 35% plus returns, and this is the green line is following that. And the same is happening for this one also. Again, 37% return, 37% return. These two are slightly below their base case, but still within the one standard deviation. And then again, 27% return and so on. This one 27% has exactly been at the base case. This rule is again at around 27% exactly at its base case. And by the way, all these rules are based on simple fundamental rules. We can share and talk about the rules that we have created. At the end, there will be a quick demo. But this is what all these are based on very simple fundamental ratios, not on complex rocket science fundamental ratios or anything. And this is what they have delivered. And this one is again 20s and around the base case. So is this one around 20s and base case. This one is around 29 and the live has been around the base case. And again, this is also 30 plus and the line has been around the base case. And this one is again 30 plus around base case, 25 plus around base case. This one is 25 but below base case. This one has almost touched its one standard deviation boundary. This is the 10-15% of the cases we observed that I spoke about. And then again, little lower, and this one, just look at this, 58 and 43% predicted returns. When we were talking about this rule in 2023, we launched this one in 2023 March. When we were talking about this and we spoke to a couple of people and they laughed it off. They said, doesn't make sense, 50% plus predicted returns. And it didn't make sense to me also. It was very, but because we had the system and everything, we could have the conviction, but it would not have made sense to anybody. But this is what it is happening in such portfolios also. It predicted 50% and 50 and 40% and delivered 40% return. That's quite a prediction framework, I would say. Quality compounder has been around the one standard deviation mark, again lower than the base. Safe Fortress also, it's a very low volatility safe product, again around the one standard deviation. And Shivalik compounder has been around 25-24%. Sinless compound is around also one standard deviation. And then Young Everest is again around 35%, which is its base case. And yeah, so the outcome that just I've shown all the charts. I think this is the slide that all of us, I guess our audience had been waiting for. We had shown all of them. We have not kept anything. The probably two outcomes I would urge you to take away from it. Intuitively, rules should be more predictable than more subjective mutual funds. But we saw that even mutual funds were quite predictable, which means that this method of predicting, or this framework for predicting futures returns, is not dependent on certain rules or certain conditions. It is more generic in nature. Second, it will not predict returns accurately only if the returns are within very moderate range of 12-14%. Even if the expected returns are in 30 and 40% range, it is predicting accurately. These two outcomes are probably might be very useful to many of us. And yes, I will show you how to create. So we have our own backtested tool, which we'll use to show how to create rules. But before that, let me take this poll. I probably know the answer. I can predict what answer we'll get from our audience. The question is, how confident are you in using rolling returns for forecasting or fund per comparison?
Okay, we are getting the responses. Few people are saying much more confident. Another couple of people are saying need to try it myself.
We don't have an option like I already knew all this.
Yeah.
Because we might have people in our audience like that.
Correct.
Okay. Thank you for responding. So hope it could help. Now, for those who are interested, I'll show you a quick demo of how you can use. We have just made a free live tool available for you to use. We use similar tool for our own products. We have made a free tool which you can use to create your own rules and backtest them using the same rolling returns and predict future with reasonable certainty. Let's go towards that. Thank you. Okay, so this is the platform. This is the tool. There are a lot of things here. What we have put in some few publicly popular investment strategies also. Almost all of them are based on fundamental ratios only, maybe except couple with non-fundamental rules also, but pretty much mostly on fundamental rules. And of course, there is a lot to explore. We'll not get into that. I'll just quickly show you how to create a screen very simply. And let us use some very simple filter, ROCE, or maybe average ROCE of the last 5 years being greater than, let's say, 20%. If anyone of you have any suggestions, please throw in for creating any rule. And let's say net sales. Net sales CAGR for the past 3 years should be more than what, 15%? No, 15% is very strict. Let's say 10%. And let's say we have one more P trailing. 1 year doesn't have any meaning. Less than 20, let's say. So let's say this is a very simple rule. This is just an example. You can just create any rule. As you select a particular parameter, you will see the description over here also, and so on. You can create any rule. I remember we created the coffee can rule and so on. So yeah. So this is the very simple rule. You can create your own rule and click on execute. Okay. Sorry, we'll have to create it again. No issues. Average ROC 5 years greater than 20, and net sales CAGR 3 years greater than 10, and PE trailing less than 15. Okay, we'll execute it. So this has sent this rule to our server at the backend. Initially, it used to take a few minutes because there are almost 4,000 data points, Apurv, or what? There are many data points which were used, but now it takes quicker. So this rule, I'll show you the rule again. I think we have it at the end. So this rule, which is ROC and net sales and PE-based rule, has generated this portfolio in the past. In 1999, it had selected Grasim and SDFC and Hindalco. And today, in 2022, it had selected these companies. And in 2024, it has selected a few of the interesting companies. Yeah, including some known ones, right? Yes. And when we backtested it, we found the average return to be 28.8% return. And the risk was 28.8%, 28.5%, the standard deviation. So when we compared it with index, the average return is higher than the index, and the risk is also higher than the index. Index risk or index ka, we are looking at 1 year, and we can look at different horizons also. So if we look at 3-year horizon, we see that let's look at 1 year only. We see that the index risk is 26%, hit rate is 28.5%. So it's slightly more risky and much more higher returns. So this might be a very good strategy rule, or this might need some more work. And if we look at calendar year returns, we can see that in different years from 2001 to 2023, how this strategy has performed versus Nifty 50. we can see that in 2002 it was 38 versus 4.25 and so on. And these are the average returns. This is the mean return which you can use to make those projections. This is your strategy and Nifty 50 for all investment horizons. This is the return percentage, and this is the standard deviation. This is the normal STD risk, standard deviation risk. And again, this can be used to make the confidence intervals. There are a lot more things on this tool. There's a Sharp, there's Sortino, there are the extreme ranges of returns, and there are a lot of other things to explore. We'll leave that for now, but this is a tool you can use. This is built on the same engine which we use to create our own products. So it's not a abstracted or very shorter version. It is the same tool, but we use it in a different way, of course. But this is the tool that we have provided for others to use. I think we can take a pause here, Apurv, and see if there are any questions. Okay, it's been quite okay. We have been almost 1 hour in this session. Thank you so much for listening, guys. And let's see if we have any questions.
This one question that is very frequently asked. So let's pick this first. So the question is, what window size do you usually take for rolling returns, and how do you decide it?
Okay. Okay, that's a very good question. We spoke about multiple horizons, and we spoke about studying history across multiple horizons. If you look at the prediction also, the predictions were different for 1 year, 2 year, and 3 year. Now, let me talk about the very fundamental principle behind it. When we want to predict weather of Delhi, let's say we have to visit Delhi next month, and we have to predict the temperature and the weather of Delhi. Then do we look at temperature across of Delhi in every month? Or if we have to visit in May, we will look at Delhi's temperature track record in May in the past years. And the answer will be yes, कि May में ही देखना चाहिए. पिछले साल May में कितना था, before the year before that, in 1990, what was the temperature in Delhi in May? But we'll try to look at the relevant the relevant time period, history to compare. If you are visiting in May, it will be useful to look at Delhi's temperature of May in history, or maybe April, May, June, around that time, right? Similarly, if your investment horizon is 5 year and above, then the investment horizon that we should choose for rolling return analysis and prediction should be 5 year and above. And when we are talking about making investment prediction across multiple investment horizons, or let me put it like this. When we are talking about equity in the first place, it should not be less than 3 years, 4 years, 5 years. So whenever we are talking about investment predictions, my recommendation will be look at 5 year plus returns. There is another chart I'd love to show you. Okay, maybe we'll show you, or maybe the next time I will love to show you, which shows that how the reliability or the repeatability of the returns increases with higher investment horizons, which means that if you're looking at 5 year investment horizon, the returns are a lot more predictable than 2 year investment horizon, and so on.
So yeah, thanks for that answer. Let's take the second question. How sensitive are your results to started bias or missing data points?
Wow, very good questions. Okay, so start date bias, how it is addressed is using rolling returns. That is why we looked at all the periods, all the rolling windows. Remember that clip, right? We didn't look at 1 year horizon or 5 year horizons only from 2000 2005, but 2001 to 6 also, and so on. So this range of returns, this volatility or uncertainty is based on the start date only. Whether we start today, if we are the average is 15% for a Nifty 50. But can anybody bet their lives that if they invest today, in the next 1 year they will get 15%, or in the next 3 years they'll get 15%? No, because 15% is average is made up of plus 20%, minus 30%, plus 100%, and so on, right? And what is varying here is the start date or the rolling window only. And that is why this the way we study rolling returns and the distribution of the entire range of returns is what is showing us what is taking away this sensitivity to start date. So that's the entire intention of using multiple rolling windows, is to take away the sensitivity and predict and to handle the uncertainty of the start date only. And that is how we are addressing it. And sorry, I forgot the second part of the question was?
Or missing data points. Started bias or missing data points. Yeah.
Yes, missing data points is a very practical problem. We face it all the time. Data integrity is at the core of, so whenever there is a rule-based investment framework, data integrity is at the core of it. There are interpolation methods, there are multiple methods to handle missing data. What we must be careful with is how we are handling missing data for different parameters. The way we handle missing parameters for ROCE might be different from price to earnings or a daily share price or debt to equity. And all the methods are good. I mean, each method is very suitable for different parameters. We should just know what method we are using, so the nuances of it, we are aware of the nuances and limitations of it. So if we have used naive interpolation, which is basically if we have missing data points in 2 years and we have data point before and after those 2 years, it's very easy, or it is very common to just interpolate. But that might have if there is a rule which is trying to identify turnaround companies, these 2 years is where the entire game is being played. So just simple interpolation might lead to those missing those corner cases. Such companies is what we need to be aware of. I'm not saying we should not use simple interpolation. We should be aware of the limitations. Similarly, there are several other methods of handling missing data. It could be truncating. It could be average across years, average across peers, different methods of taking peer comparison and averages to or industry or sector to come up with to fill up the missing data are also practiced. All of them have their pros and cons. We at our strategy level are very strict in handling missing data. We will usually let a company go if the data is missing rather than extrapolate and fill in.
Great. Let's take a couple of more questions. The next one is, what's the best way to visualize or interpret these rolling return plots, especially for clients or less technical users?
Yes, the more quote-unquote sophisticated method is to look at the returns and the distribution using standard deviation and so on. But it's a very important question. How do we? I think I might have a chart. Okay, let me share my screen and show you this chart. This is very useful. Okay. So this is a very good visual representation of rolling returns. The blue line is one of our rules, or any rule or strategy that you can create. And the red one can be the benchmark comparison. We have just kept Nifty 50 here. And what this data means is, as on July 2004, the return by index Nifty 50 was around 70-80. This is 1 year return, 1 year rolling return. 1 year return by Nifty 50 was around 78-80%, maybe 85%, right? And in 2009, just after the subprime crisis, the returns were almost 200 for Nifty 50 were almost 100%, and for our strategy it was almost 200%. And then there were negative periods and so on. So this rolling returns tells us what are the worst things to predict, what worst things we can expect. So 2008-9 was this worst, where we saw almost minus 56% drawdown. And then there was this 2019 period wherein small cap, this is small cap strategy. Small caps from 2008, we remember small caps took a major beating in India. And we can see it here. Nifty also was almost touched zero in 2019. And then we know COVID 2020, wherein everything had a very sharp fall and very sharp recovery also. And the shades can tell us when you outperformed and vice versa. So the blue shades is when your rule, your strategy has outperformed the index or the benchmark, and the red one is the vice versa. Now, I'll tell you, this is just 1 year rolling return, right? And somebody also asked what horizon to choose. And I mentioned that I might show you something which will tell us that longer the investment horizon, higher the predictability, right? So this is 1 year investment horizon, rolling returns. Keep this in mind, don't forget. And let's look at, I'll jump straight to 5 years. Hope it is visible. Is 5 years rolling return visible, Apur?
Sorry. Yes, it is visible.
Okay. So the very why I did not show you 2, 3, 4 years is so I can show you the contrast quite starkly. 1 year rolling return, the volatility is quite high. For 5 year rolling return, I mean the extremes, the best and worst cases are quite frequent. There are negative returns also. There are periods of underperformance also. When we look at 5 year rolling returns, negative returns are almost null. Blue shades or the consistency of performance is very, very high, right? So so this is a very good way to look at rolling returns for clients and so on. But at the same time, this also tells us that higher the investment horizon, more predictable, more safer are the investments and so on. And just let me show you one higher investment horizon of 8 years also. And look at this 8 year chart. And I think everything will be crystal clear to you that what it means to have higher investment horizons. Watch investment horizon should one have and keep the expectations from equity markets for sustainable long-term wealth creation, not to get into panic situations or in situations where we might have to liquidate in bad times because we entered with very short investment horizon. Those very fatal mistakes, which our audience, I'm sure, are not doing that mistake. Our audience is, but many people, even the most intelligent people, can make that mistake. But yes, having longer investment horizons in equity is a must. Is visible across every chart that we saw. So I hope I answered the question.
Yes, thank you. So I think we can go ahead with the polls. There's one poll pending, Kisle.
Sure. No more questions, right?
I think, yeah, we can wrap
Okay.
it.
So this poll is assuming and hoping that this session was useful. We could add some value. We tried our best. Thank you for listening. But is there anything, any feedback or suggestions on what would you like us to show if we have another session next time?
So we have most of the votes for either mutual fund rolling return dashboard or the portfolio level probability view.
Probability view is something we'll add. That's a very good measure. And dashboard, mutual fund dashboard, Apurv, you want to answer that?
So what we'll do is we'll add this functionality to backtest mutual funds in our BT tool that Kisle demonstrated. And from there, it will be very intuitive to go ahead and backtest any mutual fund that we want to. Even we'll add indexes there so that indexes and mutual fund both can be backtested, and you can go through the returns and stuff.
That might be very helpful. I'm sure people are here to create their own rules, which we already demonstrated. which was a more complex part. But people also want to compare mutual funds and indices. And I think it will be very easy to add it in our tool, right? Because like this will be a very small thing compared to the rule creation. Is it, Papul?
Yes, it is.
Right. Let's add mutual fund and index then to the tool, so it might be helpful to our audience. I think that is it. Again, thank you everyone for listening. I hope you enjoyed. I definitely did thoroughly. We can probably end this, is it? Thank you so much.
Yes.